Welcome back to Sunrise. Well, we're just a few hours away from the start of a two-day Senate inquiry into the government's controversial budget. Business owners, economists and investors will have their say on the proposed changes to capital gains tax and negative gearing.
It follows widespread backlash, with experts warning the plans could slow growth, sending investment overseas and result in fewer jobs as well. For more, we're joined by Shane Oliver, AMP Chief Economist. Good to have you with us. So the business industry says these tax changes will kill innovation and investment in this country. What do you think?
Look, I think that's certainly a risk. What we're talking about here is the capital gains tax changes, and they can be quite onerous. The proposed approach is quite onerous, particularly for startups that have low levels of capital or zero capital initially. Say it's a tech startup. So that's certainly a risk. I think there's also a danger in relation to the share market, that will be less capital in the share market for startups when they eventually list. So there are issues that really need to be looked at there, and hopefully that will happen.
OK, so putting aside small business now, let's assume that this all goes through. Take us to July 1, 2027. What do you think that the major effect will be for the mums and dads?
Well, I think you've got to break it up into groups in the economy. For first-home buyers, I think there will be an opportunity. Investors are vacating the market to some degree, waiting for lower prices or higher rents because of the reality that the after-tax rate of return on their property investments will have changed. So we are seeing a weakening in the property market. That's enabling first-home buyers a bit of a window if they want to get into the property market. The flip side, though, is this risk that over time we may see less rental property coming to market, and that could mean higher rents or on the back of a lower supply of property. So they're the main risks, I guess, in relation to the property market. For the share market, I don't think it's going to have a huge impact, but there is that risk there that there may be less capital allocated to new investments.
There's speculation at the moment the fuel excise, moving on to something else, could be extended. It's set to end the end of this month, so July 1, it'll come back on. That will then therefore put fuel prices up. Do you think it should be extended at the moment based on what we're seeing globally and particularly in the Middle East?
Well, as a motorist, I welcome the fuel tax cut, but from July, I'm actually, like Bob Dylan in 1965, going electric. I'm getting an EV, so it won't impact me that much going forward. But as an economist, I don't think they should be extended. There are good chances, fingers crossed, that there will be some sort of deal to reopen the Strait of Hormuz. Lots of uncertainty around that. But more importantly, I think extending it does cost the budget. It'll cost $2.5 billion, roughly speaking, every 3 months that it's extended for, so that's $10 billion over the course of a year. And there's also better ways to help people that need it, better ways to help businesses, better ways to help low-income earners who might be struggling with their fuel bills. So I think it should be discontinued as scheduled at the end of this month. OK. Do you think that if it was extended, it would push up interest rates? Look, I'm not totally convinced it's going to have a huge impact on that, but there is a risk that if you do these sorts of things, like we saw with the electricity rebate, it does allow more money in the hands of people, and they can spend on other things. So that can add to interest rates, but that's a marginal impact.
OK. Shane, thanks for your time. Really appreciate it.